Hi fam, welcome to Elektron FX. And in the previous video, we talked about technical analysis. We talked about the three kinds of technical analysis, or three kinds of forex analysis. We talked about the fundamental, the sentimental, and the technical analysis, right? So today, this is the beginning of the bootcamp, right? If you are new to forex, you can go through the pre-bootcamp videos where we talked about the introductory aspects of forex and what forex is all about in a nutshell, right? So today we'll be going straight to the topic, which is market structure slash technical analysis, right? So when we talk about technical analysis, I said in the pre-bootcamp that is simply using the price previous data to predict what's the future, right? So using the price previous data to predict what's the future. So what do I mean by that? Look at this chart now. So in trying to use this past candle pattern, this movement up, down, I want to use this to predict what price is going to do current. This is the future, and this is the past, right? So this is the future. This blank space is the future. All this space, to predict what the market is going to do here using what? The past previous data. That is what technical analysis is all about. And then now that brings us to what we call market structure, right? Market structure. Now, as a human being, what makes up the human being, the structure of the human being. We have what we call the skeleton, we have the bones, the flesh, the blood. What are all those things are what makes up the human being structure. So when it comes to technical forex market, we have what also makes up the financial market, right? So that's what we call market structure. And basically we have basically 3 or 4 types. They have 4 words. They have 3 main types. Like we just mentioned the 4 types, right? 4 types of structure. So we must mention the 4 types of structure, right? The 4 types of structure. Right. The first one we have is what we call the uptrend, right? We have the uptrend. Just for number 1, we have uptrend or bullish market. So we can call this a bullish or uptrend market. So that's the first one we have. We have the second one we call the bearish or downtrend market. Call it a bearish or downtrend. So that's the second kind of markets we have. And now the next one we have is what we call the range, right? So people call it the sideways or range. So in brackets, you can call that a consolidation. These are the names you give to this kind of market structure. Call it sideways, range, or whatever. And now the final one, what we call the chopping market. Chopping market is basically has no direction, right? Just want to add this to make it 4. So these are the 4 kinds of market structure that we have, right? They are just 4. We have uptrend, downtrend, this and that, right? So, okay. Let us just copy this to the next page. Trading view. All right, so these are the 4 kinds of base market structure that we have. We have the bullish, uptrend, bearish or downtrend, the sideways or the range, and then we have what we call the chopping market, right? So now let us talk about the first one, which is called the uptrending market. Now let us keep this at the side. We'll start with the first one, which is called the uptrend. Now in an uptrend, find the market doing this. So that an uptrend basically looks like, right? This is Euro JPY trade. So that an uptrend looks like, basically. It looks like this. So we're going to label this and explain. Now, if you look at the real chart, look at this. Look at this. You can see that this market is doing this. Can you see this? Goes up, come down, goes up, come down, go up, come down, go up, come down. Can you see it? So this is an example of an uptrend in the real chart. Right? This is Euro JPY chart. Right. So let us go back to what we're doing. So this is an uptrend. So an uptrend basically looks like. Right. So basically look this way. An uptrend. So you can simply attach the text there. Write what's uptrend. So an uptrend relatively goes up. It's relatively going up. That means even though it comes down, it goes up. The overall direction is what? Upwards. Now, one thing about the uptrend is that it makes what we call higher highs and higher lows, right? So let us label that. We have heard about it somewhere, but I'm going to still go over it again. So this is the uptrend, the first example of an uptrend. So if you put it here, you can now clone this, right? You can clone it and drag it here. It's called a higher high. Clone it again and drag it here. It's called a higher high. So let us label the lower part of it. This is market structure now. We are trying to label these things to get it the perspectives, right? So this is it. Higher low. Call this a higher low. I'm going to give you 3 rules of market structure for an uptrend. I'll give you just 3 rules, right? I will give you 3 rules. So this is a higher low, right? You can label these things on your own. So this is what an uptrend look like. Now the 3 rules of market structure, write it down, write it down, write this down. You have 3 rules of market structure. The first rule is that a higher low, the new higher low must be higher than the previous higher low. The new higher low must be higher than the previous higher low. That is the first rule. And the second rule is that the higher high must be above the previous higher high. A higher high must be above the previous higher high. That means if this higher high stopped here, it's not a higher high because it's not above this. So this now becomes a higher high, and this is your next higher high. This is no longer a higher high because it's not above this. But for the market to go above, that makes it a valid what? Higher high. Now, the final rule is that before a higher low is called a higher low, it must, number one, be higher than this low, and it must create a new higher high. That means if this higher low does not create a new higher high, this is not a higher low. That means, for instance, the market does this, right? Does something like this. This is not a higher low because it does not taking price above this higher high. It's still below this high. So this is not a higher low yet. You can remove this. It's not a higher low yet because it did not take price above what? The higher high. So now, once the market does something like this, it now comes and does this before going up. So now, this could not take price up, but this one take price higher than this higher high. So now this becomes what? Our higher low. This becomes our higher low, right? Why? Because this one could not take price above this higher high, but this one took price above. And remember that this one was above this one. So this becomes our new higher low, and this one becomes what? Our higher high. Okay? Do you get the gist? So that is it about market structure. So we have to follow these rules. We have to follow these rules to be able to maximize all this. So that is how it is formed. Your higher high must be above the previous higher low and all of that. So let us go to the second one, which is called the downtrend. The downtrend is simply the reverse case. The downtrend is the reverse, right? The downtrend is the reverse. So downtrend is simply when the market is doing the opposite of this. When the market is trending, going downwards instead of going up. That means the market is doing something like this. You go up a bit, come down. I will tell you why the market goes up and come down. I will tell you that in a few moments from now. So what the market looks like. It forms this and then continue going down. So the overall direction of this market is downwards, right? But it still comes up a bit before heading overall downwards. So this is what we call a downtrend. A market that is trending what? Downwards. It's trending downwards, right? So now we can now we don't know what to do. We can now label it, right? So we labeled it. So we clone our tool, take it here, right? So you can simply label this. Remember, this one is different, lower high. No, we clone it again. Have what? Lower high. We clone it again. We have what we call what? Lower high. So this one is different from the previous one. It's labeled different. This is the second kind of market structure, right? So now we have what we call the lower low. I don't want to make this video so long. So we clone again. We have the evening section, and that will be the continuation of this. Please just introduce this concept to you, just to introduce to you. So I have what we call what? The lower low, and the lower highs. So this is the second kind of market structure we have. Now, remember the rules. The first rule of a downtrend is that number one, the new one must be lower than this one. This one must be lower than this one. Therefore, the lower lows, this one must be lower than this one. This one must be lower than this one. As the price is going to the future, this low must be lower than this low. And now the final rule is that the lower high must take price below the previous lower low. That means if this lower high, right, let's assume that this could not take price below it. This is no more a lower high anymore because it could not take price below, right? So it must take price below this lower low for it to be called a lower high, right? So that is the rules, or the 3 rules of a downtrend and an uptrend. And now let's look at the next one, and then that's what we call the sideways range of consolidation. The sideways market, right? So in a sideways market, it looks like this. I will use a moment to introduce this to you. So it forms what we call a support and a resistance. A support is simply a floor, and the resistance is simply a ceiling of price. I will explain that. So now let us just label it first before we talk any other thing. So we call this a support. As a standing on the ground is supporting you, right? So that is your support because it's below, and then the upper one is what we call a resistance. So a resistance. Resistance is like your ceiling in your house. It's a resistance from going upwards, right? If you want to throw a ball, let's assume you throw a ball, right? So it looks this way. What the market does is that the market does something like this. It comes inside this box. It's kind of bouncing in between, it's bouncing in between this box. It's not giving a clear structure, right? But they just do something like this to come down, to go up, to hit the upper part of the box, go up, and that's what a range looks like. So this is what we call a range. That's what we call a range, right? What we call a range. What we call a range. So that's what a range looks like. It's what we call a range. Now, let us look at Richard to see if we can find any of these things. Now, we have seen an uptrend there. Let's see if we can find a downtrend. Right, so okay, look at a range here. Look at the range here. This is a range. Look at this. The market was in between these two zones. Look at this. Can you see this? The market was in between here. And look at this. Look at this one here. So this is what we call a range. Can you see this? How the market was bouncing in between these two boxes. So that's what we call a range. That's an example of a range. This is a real chart now. I didn't form this. I'm looking for a downtrend, but I can't really find one now. Okay. I think I've seen the downtrend. Look at it. So it's lower high, lower low, lower high. Say the market was going down, going up, coming down, going up. So this is an example of a downtrend, and for that. So you can use your own time to find more of this, but I'll give you an assignment. So these are the three kinds of market structure that we have. These are the three kinds of market structure that we have, right? We have the uptrend, downtrend, and then the resistance. Now, let us talk about the choppy market. The choppy market basically is not part of this. I just want to add it. Choppy market looks like this. Does not have a direction. It just does this. The market go up to come down. Does not have any particular direction to be like this. To come up again, to come down. So we can delete this one from it. So it's not when it's in the market not having a direction. It's not going up. It's not going down. It's just random, just up, down, left, right. You should not trade it. So these are the three basic kind of markets we have: the sideways, range, bearish, and bullish market. Right. So I don't want to make this video so long. I want to talk more about this in the next video, right? But let me just use a scenario just to illustrate uptrend and downtrend. And this is technical analysis now, right? For you to make money from the financial markets, you want to buy the market when the price is low. I want to sell on the side. What do I mean by that? Let us also use a simple example to illustrate that, right? Let's assume that this is a price chart. This is a price chart. I'm using this to explain this now. Now let's assume that when this maybe a car came out and the car was sold for how much? The car was sold for what? $100 or $100 when the car came out. So people bought this car at $100, and then when people buy something so much, what happens is that the price goes up. Now this price that was 100 now before, remember when you start buying things, the price will begin to go up, right? Like in the market. So people are now buying. Now the price now goes to 200. What do you think they're going to do? These people that bought their goods, they will start selling it, and nobody want to buy it, will not want to buy again. So the buyers will now be few because why? The price is high. So this is it. Now, when the price is high, the company that sells the car will say, okay, people are not buying this car again because the price is high. What they do? You see something like Black Friday, right? Yeah, discount, 40% off, 50% off. Let's assume that they gave maybe 25% off. Now, what's happened that this price is going to reduce. Instead of being 200, it's not dropped to maybe 150, right? So that is, I'm just starting to explain uptrend to you, so you understand this thing. And I'll also explain only uptrend. Maybe I'll explain that in the next video. So now we can see this 150. Now, what happens is that since people are not buying again, they'll not do Black Friday and the price comes to what? 150. Now, when the price comes to 150, people will not start to do what? They'll start buying it again because what? The price has reduced from the previous price. So the goal of trading is to buy when the market is low, right? So this is a rechart now. When the market, this is a rechart. So when the market comes low here, you want to buy here. When the market goes up, you sell. When it comes down, you buy. But in a bullish market, you're looking for only buy. Since the market is overall up, you only buy. You can buy, allow to go up, come down, you buy again. So you said the market has been going up. If you bought here, it will take you up, come down a bit, you buy again, it goes up, you buy. So that is it. So you are waiting for the price to come down before you buy. That is the goal of trading. You make money when you buy something at a low price and then it goes to a higher price, right? So that is it. So you are seeing that it has come to 150. People now start to buy. What will happen is that this price will now skyrocket. It's no longer be 250 again. It's now skyrocket to maybe $300 because people are not buying it so much. You know, when the demand for a thing is high, the price goes up, and up. So this is it. So you see this, the market has gone to $300. Now, nobody wants to buy it again because the price has gone up. This is now favoring only those selling. So now what to do? They just say, okay, nobody's buying this thing again. What do they do? They'll not do a discount, Black Friday. And then what will happen is that the price will not crash again. It's not crashed to maybe 250. And you see people start to buy it. That is just the idea of trading. You want to buy when the price is cheap and selling when the price is expensive. When the thing is cheap, you want to buy them. So this is about trading. Can you see this? So now the price will not dump. Price not dumps to 250. Remember when deep, they say buy the deep. No, buy the dip means that when the Bitcoin price goes down, you want to buy it so to go up and your money will increase. So that is it about trading. You want to buy when the price is low. This is about an uptrend. Why the reverse is for downtrend. That means if the price is high, you want to sell to make profits. That means maybe you are selling cars. I want to just use it to wrap this up. I don't want to add it, but I will still add this. I understand this concept now. I want to understand market structure to the simplest. I want to understand this thing as easy as ABC. So let's assume that the thing came out and maybe you have 15 cars and you sell something at $300, and then what happened? The price of the goods now maybe reduced in the market. You don't want to sell it again. Maybe the price reduced to, let's say, $300. That drops to 200, right? It drops to 200. You guys selling the car. You won't want to sell the car again because that's reduced. You won't make it so much profit, right? So you wait for it to do what, to go up. So now maybe the car's price now goes up again. It goes up to maybe 250, but you don't start selling your car again because now the price is what, higher. This is about downtrend. You want to sell when the price is high. It's the opposite of uptrend. Uptrend, you want to buy when the market is low, but on downtrend, you want to buy when the market is what, when the market is high. You want to sell when it is high, right? You want to sell the market when the price is very high. So when it comes there, you're selling here, and the market is now going down. It's now from 250. You're not selling that to go down to maybe 100. Let's assume that the thing dropped to 100 here. So you're saying you're making profits. You're making profit because since you sold at 250, you cannot buy at 100 too. Can you see it? Can you see the beauty of this? This is market structure. This is just basically the what we do in our local markets. So now the price now drops to 100. Since you sold at 250 and the price drops to 100, you say you have made gain because you cannot buy more cars at cheaper prices. So you can see that you cannot buy it. This car that is sold for 250, you cannot be buying it back at 100. Wait for it to go up again, maybe to 150, then you sell. That is it about market structure. You want to buy this one when it is low. You want to sell this one when it is high. So you have to look at what the market is doing. You have to look at how the market is moving. Okay, I'm seeing the market doing. Look at the market pattern. It's going like this. Okay, this time, okay, I'll be buying this market. I'm looking for buys because why? The market is going up. The side how it is doing, it's going up, down, up, down. So you want to be buying this market and taking the price higher. You want to buy and take the price higher. So I will call this a day for the morning section. In the evening session, we'll talk about break of structure, and then we'll talk about more things. So I'll just give just one assignment to wrap this up. Just one assignment. So these are the assignments for this video. Just assignments. We have evening session today. Our evening session. So this is it about it. The assignment is this. Use your MT5. I've not taught how to use student viewers. Use your MT5 or MT4 to identify the three. Let me just label it. To identify, let me just label it myself. Identify uptrend, downtrend, and what? And range. So just use your MT5. When you see it, you screenshot it, you type uptrend, you see it, you screenshot, you type downtrend, you see range, you screenshot and send to the group. So that is the first assignment. And then the next one is that go to babypips.com. All right. And read on support and resistance. So that is it. So the support is simply the one that is pushing price up, while that is the one that is pushing price down, right? So you just go to babypips.com. This is how to do it. Go to babypips, just click on babypips.com, right? Babypips.com. Just go to babypips.com, you will see where you will do that. I'm not taking it, so you will see it yourself. Just go to the pips.com, then you come here to education. Can you see that? You come to education, all right? You come to education. So when you come to education, you click on School of Pipsology. Yes, how to trade forex. Under education, then you see the topic. You come down. This is preschool. What is forex? So you come to elementary, and this is it. Support resistance. So I want you to read this and then summarize it and send to the group. Those are the two assignments. Number one, use your MT4, MT5, identify uptrend, downtrend, and range. And the second one, go to pips.com and read your support and resistance, and then send your answers to the group from 2 p.m. From 2 p.m. Yes, from 2. So send your answers to the group. Right. So that'll be the end of the video. We're having our evening session. I'll be talking more about microstructure. Please, the least you can do, this is a free training. Many people charge for this. The least you can do for me is to like this YouTube channel, subscribe to the Telegram channel, share with your friends, and repost this training as often as you can. That's the best you can do. Since this is a free training, so just help us by liking the video, subscribe to the channel, share with your friends, and take this training very serious, because no one will do this for you for free. I just want to give out to the society from what I have learned, and that will be all. So have a wonderful day, and we'll see you in our evening session.